how's my existing position doing, right? In the example that, I mean, this is a tangential point, but sometimes, not always, usually not, but sometimes I've found that the GP does not understand how's the position doing. Um, However, I always say it's always a good idea if you get a capital call email to ask the GP, like, hey, I invested 500 grand. Could you please help me understand how much that 500 grand is worth today? Um, by using numbers, like, meaning don't just tell me like, oh, I think it's 500 grand, right? Like, but show me like the capital stack, i.e., how much equity was invested, how much debt was invested, right, et cetera, and how much is the project worth today, right? Maybe put some sensitivities around that because you don't really know what you can sell it for exactly, right? No problem. But at least I know, like in a framework, in your example, the debt was 70. So like, is my position worthless because the project is worth 70 and we can barely pay off the debt if we sell it off? Or perhaps it's 80 and 90 or 90 where my equity is impaired, but not all the way. Um, the other point that I'll mention is that question is inherently um, it's flawed because it's point in time, like today. I mean, you're doing a capital call, so chances are there's some form of problem, right? But all problems are not created equal. In other words, there could be a scenario, and I've seen this. There could be a scenario where the building is worth 60 today, um, but like it's actually very realistic, like conservative, really realistic, that you can get it back to 100 in 2 years. Now the question at that point becomes, well, do I want to wait 2 years, 3 years, to reinvest just to get my money back? Is that worth the risk?
Hi, Adam Gower here, founder of GowerCrowd.com and host of the real estate reality show at youtube.com/GowerCrowd and on all good podcast channels everywhere. Welcome to today's episode. My guest today is Aleksey Chernobelskiy, who is principal at Centrio Capital Partners. Aleksey helps LPs with, quoting from his LinkedIn profile, with existing and future investments. And he writes tips, advising or providing educational content to LPs to help them navigate the current market as well as make decisions on how to act and what to look for as they consider investment opportunities going forward. I actually came across Aleksey on LinkedIn, and he is a prolific writer. Aleksey's background includes having run a $10 billion commercial real estate portfolio, and he has a quadruple major, oh my goodness, from university in finance, mathematics, economics, and accounting. He's a very bright fellow, and his insights are largely based on conversations that he has been having with literally hundreds, if not thousands, of limited partners who are facing issues with some of the deals that they've invested with, as well as wanting some independent third-party counsel on how they should be thinking about the commercial real estate investment environment in 2024. If you want to know more about Aleksey, please go to the podcast page at GowerCrowd.com. And while you're there, be sure to subscribe to our newsletter. It goes out every week, covers the latest news and updates in commercial real estate syndication. And it's totally free. You can always unsubscribe, but we do include educational content that is usually free and sometimes some premium stuff, but it's all there at GowerCrowd.com. Also, you will hear Aleksey talking about one of his articles today. I'll include a link to that also on the podcast page. All right, without further ado, Aleksey Chernobelskiy, he is my guest today and is going to be talking about his views based on conversations largely that he's been having with limited partners through this cycle, founded on his experience of having run such a large commercial real estate portfolio. Here he is, Aleksey Chernobelskiy. Alexei, nice to meet you. And before we start, I am going to adhere to your one request, and that is to disclaim all responsibility for anything at all that you say, because we've never met before. I've got no idea who you are. You don't know who I am. So this is purely for educational and entertainment purposes. Is that a good enough CYA for you? We're good there?
Yeah, that's perfect. Hopefully, the balance of education and entertainment is good.
That's right.
For
Well, it
both
is
of them.
video as well. So I don't
Yeah.
know.
Thank you so much
Maybe
for thank you for having me on.
God, it's a great pleasure. I've been following you for a while. Alexi, why don't we start with your background? All right. And what I've been to your website, it's a single page landing page.
Yep.
Your principal, Centrio Capital Partners. What is your mission?
Yeah. Thank you for having me again. In terms of background, I've been in all types of buy side roles. The most recent one before I went out on my own was leading the underwriting and portfolio management team at a public real estate investment trust. Led a 20-person team that essentially um, looked at any transactions that came in, and also managed the $10 billion exposure that we had across, by the time we left, it was pretty close to 3,000 properties all across the US. In terms of my venture now, my goal is to make sure that LPs don't make mistakes, they get into investments understanding the extent of the risk that they're getting involved with. And I think that's the overarching goal. Is just putting making the GPLP marketplace a little bit healthier. Maybe that's another way to put it.
Okay, good. We're on the same mission. So you're
Okay.
talking to LPs, and this is a double barrel question. I'm going to let loose barrel number one.
Let's go.
And that is what kinds of so the LPs that you're talking to, we're going to talk about that in a minute and the characteristics, etc. But the LPs that you're talking to, typically, what kind of scale investment overall are they making? Like, what are the size of the sponsors that you're hearing them talking about? Maybe that's a little out of sequence. We'll come back to the bigger picture in a minute. But what is the
Yeah, yeah.
scale overall?
Totally. I mean, I'll get calls from institutional LPs that are putting in 10 to $50 million checks. Um, but most of my conversations are actually with retail LPs, is what I like to call them. So you can think of doctors, software engineers, um, in some cases teachers, and all the way up to sort of like in terms of net worth to like business owners that perhaps are worth 10, $50 million and they want to place 1 million, or they want to place 500K or 100K. And the way that I like to categorize the the folks that call me is people that are extremely bright and successful in sort of their area of expertise, but are not necessarily experts on investing. And like everyone, they want to grow their savings, and they want to do it without risking too much capital, and understanding what they're doing. That's
Okay,
really it.
so where I
Yeah.
was coming at from that, they are for the most part, apart from the institutional investors that are calling you, which is very cool. The majority of people that you're talking to have invested in, and this is a question, non-institutional scale, non-institutional sponsors. Would that be an accurate characterization? Smaller deals, they've invested, 25 to
I would say
100,000.
probably about 60 to 70%. That's accurate. With the rest being, they're investing in institutional funds, and sometimes those amounts are. I mean, I just did one recently for a few $1 million of an investment, which was, an LP looking at a pretty massive institutional fund. But again, I think that the majority are certainly LP is looking to place, let's say like 100K to 500K, that range, into let's say sub $500 million AUM GPs.
Sub 500 million of 500 million AUM assets under
Right.
management for that one person that doesn't know what that means. So
Yes.
the smaller scale, medium scale, small to medium scale sponsor. All right. So
That's right.
so what do you do? Actually, I suppose the easiest way to figure out what it is that you do is to ask, how do you make a living?
Yeah, sure. So,
You're not still training people to do ping pong. I noticed that. It's a
oh
very cool
yeah,
background.
yeah. Yeah, it's been a while since I did that. Yeah, so a few there's like a few streams of income now. The practice or the business is just me. I do everything. And essentially, there's like a few tiers of services. One is someone who perhaps has money to invest but isn't sure how to do it and wants to learn. So I write a weekly on a Substack called LP Lessons.substack.com. And as of this morning, I think there was 2,400, a little bit over 2,400 investors that were subscribed to that. For those that want like more detailed information from there, they can have a choice to get premium membership, which gives them access to a lot more um, articles. So that's sort of like the lowest tier offering for those that just want to learn kind of passively straight to their inbox. And then folks that have either an existing LP position that they need help with, that might be a capital call, or some reason why an LP needs to understand what's happening with their investment. I can help them understand what's going on and help them think through the decision. Um,
And you charge for that, do you?
that's right. Yeah, and also on future investments, like I said, like someone has 100K that they want to put into a deal, so they can send me the deck, and I just provide feedback on the deck. I essentially just imagine that I'm investing my money and think about the questions that I would ask, and hope it helps people.
Right. So let's look at both of those scenarios. So somebody calls you and they have, by the way, if you're listening to this podcast, you can't see it, but if you're watching it on YouTube, you see I've got this screen behind me with lots of scribbles on it. It's all about capital calls, which is pretty dominant in the market today.
Yeah.
Distributions stop and then they go to capital calls and etc. So let's just say, so that is the topic of the day, at
Sure.
least of the market where we are in the cycle at the moment. So you get a call from somebody that says, I invested in this deal in Texas. Both you and I have got strange accents, so I'm going to try and do an American accent once in a while. They got this deal that I invested in Texas, and they just got an email from the sponsor that says, we've run out of money and we need you to pony up another 50% of your original investment. What do you do? And then they hire you to advise them. So what's your process over here?
Yeah, so a lot of times it really depends on a lot of stuff. I'll tell you just as an example, many times people will call me, um, and my first question is always, do you have the money? Like that sounds like such a silly question, but many times the answer is no, like I was gonna borrow it from someone, or I was gonna pull, I've heard like I'm gonna pull on my HELOC, that's like at 10% or whatever, sometimes higher. Or like I'll borrow
Home
from
equity line of credit is that's
yeah,
right.
I'm
So in
sorry.
other words, a
Yeah, yeah.
second mortgage on your home. Yeah, I'm just filling in the gaps for
Right,
that one
right. And
person
I
that
think
doesn't.
what the point I'm trying to make is whether you should do a capital call or not, fundamentally is just an investment decision, right? Meaning just like you made an investment decision to invest in the sponsored day zero or day one, however you want to call it. So two, right now you need to make a decision about whether this capital call, this marginal cash is going to produce you the returns that you can't, that you can otherwise get somewhere else, perhaps at a lower risk even, right? So now before you even get to that, my point was, do you have the money, right? And if you are borrowing the money, um, or there's any economic relationship to getting the money somehow, it becomes even more complicated because that's sort of like an even higher hurdle to hit in terms of thinking about this. Like if the money is just sitting in a bank account and is free, so the investment decision depends on um, your marginal investments return against what you can make in investing in new syndication or putting into the stock market or buying treasuries, whatever, right? And you sort of have to weigh those on a risk reward basis. But if you're borrowing at 10% to fund that capital call, well, like you have to add that 10% into those equations, right? And that just the dispersion, so to speak, of cases where it makes sense to borrow in order to fund a capital call, and many times just makes it like almost not even worth continuing the conversation, you know. So there are, and I'm happy to kind of go through the list if you'd like, but there's sort of like a series of questions that I ask. The
Sure,
first
fire
one,
away.
um,
Yeah, tell me.
yeah, I mean, the first one is always that like, do you have the money? I think from
So hang on,
other,
let me just pause you on that. And I would like to hear other
yeah,
questions,
sure,
but to me, it's mind-boggling that anybody would, I don't mean to insult anybody, but that anyone would borrow to invest. It seems counterintuitive to me. It's almost
yeah.
impossible to, I can't imagine how you'd make the numbers work. But
Why would someone do that? Is that the
yeah,
question?
right. Yes. Oh, yes,
Um,
that's exactly where I was going. Is the
yeah.
idea of a capital, so the way that you approach, and this is frame, I'm going to frame this in the sense of a question.
Yeah.
Is the idea of when you see a capital call and when you talk to investors, are you talking to them? First of all, are you advising them? I suppose that's a technical term. But are you talking to them about this capital call as being a new, completely new investment, completely from the original investment? Or do you contextualize it as an investment to protect the original capital investment? How do you see it now? Those two angles.
Yeah. So I think the first thing I would say is for anyone who wants to like understand this, I'm not going to be able to get to this in detail on here, but for anyone who actually wants to like delve into this topic, the specific topic that you just mentioned, Adam, I have a specific article on this, and it's called "Do Sunk Costs Matter in Capital Calls?" And so basically what you're referring to is kind of like this weird um relationship, right? Because on the one hand, you've already invested the money, and the all the economists, so to speak, tell you, well, that's a sunk cost, so like that shouldn't influence your decision, and this is essentially a new investment. On the other hand, and this is where it gets very tricky, and I had like there's an entire model on that article that I mentioned showing this and kind of going through an example. But the reason why it gets tricky, Adam, is not investing typically comes with dilution implications, right? And I don't mean normal dilution, like, you used to own $1 out of $10, someone invested another dollar, and now you only own $1 out of $11. That's sort of like pro rata dilution. They're like uh, not much of an impact to you. Now, what I see happen many times is like um there's like a 2x or a 3x dilution. There's many ways of like, kind of explaining or uh, putting legal language around that. But at the end of the day, you end up um suffering, so to speak, a dilution on your original investment as a result of not investing.
A
Um,
compounder.
and
It's a compounded. It's no pro rata. That's the point you're making. It's not pro rata. It's it's a complete crushing, basically, in terms of the dilution. That's the
Yeah,
point you're making.
sometimes in the venture capital world, like and some other worlds, like it's called and kind of called a cram down. Like
Cram down.
basically existing investors will get crammed because of a distressed raise that's coming in.
Mhm.
And this is not always the case with the capital calls, but this actually touches on one of the first things I ask after making sure that they're not borrowing money, which is what happens if you don't invest? Like the conversation basically doesn't start before you know that. Um, and sometimes the answer is nothing. In other words, you become $1 out of $11. Sometimes the answer is you become $1 out of $101, right? So meaning like your original investment essentially evaporates, right? And so at that point, like the sunk cost nature of the original investment becomes very tricky because what you can think about, and this is what I have in the model spelled out in detail, is like there's really like two streams of cash flows, right? One stream is what did you invest and how much is it worth after dilution, right? The other one is like what are you investing now, the marginal investment, and what do you expect to make on that money? And so you have to really compare not investing but getting diluted. That's sort of scenario A. And scenario B is investing the marginal cash and as a result of investing, not getting diluted with the original investment. And the only way you can compare those is a business plan. Like meaning you need to know in like 2 years, 3 years, whatever it is, like what are you realistically expecting to make on your original investment and the marginal investment, and is it better from a return perspective to invest the marginal money, which is a new investment, as you said, and it should be treated as such, but it has to be kind of thought of in conjunction with the original one and compared to what you can get elsewhere. That's the point. So the answer, I mean, I hope that's clear, Adam, but like the answer is actually both in a sense. You can't divorce the two principles because they're actually very connected.
Right. I've got to take some notes. It's a fascinating discussion, Alexey. I know we're not going to have enough time today.
No, it's
But
okay.
let's just drill down on some points as deep as we can, and maybe we can pick it up later. But
Yeah,
before we do me a favor, just pop the link to that, if you don't mind me
yeah,
sharing it. Pop that link into the chat, will you? And I'll include it in the
100%.
show notes on the
Of course.
website on the webpage. So let me start. Let's drill down on this concept here because we
Yeah.
also talk to investors frequently, and it's we also talk to um, rescue capital shops and to sponsors and etc. Very similar. Thanks very much
Yeah.
for doing that. I will include a link to that article in the show notes.
Awesome.
You'll see that on the website. So you ask first, have you got the capital? The next question is, what is the dilution? Okay. So to what extent do you find investors actually know what the result of them not investing is? Because you go through these contracts, some of them 200-300 pages long. They're like the length of a novel. Right. I've seen
Yeah.
them 50, 60,000 words long. I mean, you've got to have a PhD in law to know what's going on. And even then you've got to be able to unwrap all the details. So to what extent do investors actually know, and how deep do you dive when if somebody says, I've got no idea?
Um, well, so one by one, first, to what extent do people typically know? I would say the majority of LPs, when they get a capital call email, they do not know. And this is just my opinion. I think that's on the GP to communicate, right? Meaning that part of the communication package from the GP has to be like, here's the situation that we're in. Here is the money that we need. Here are the uses of that money, right? And here's why this investment makes sense. It's no different than them convincing you to put in capital in the beginning. This is just another investment, and there needs to be a business plan, and like it needs to be clear why the marginal cash will make the money. As part of that, and it's very typical to do so. You have to tell them like you have until Friday or whatever to decide.
All right.
Um, yeah, it's
I mean,
always,
that's the wacky thing. By the way, that this whole thing behind me is exactly that story. Not, 90% of the time, most sponsors know 6, 9 months ahead that there's something heading, but they wait
yeah.
until the last minute. It's like, okay, capital call, we need the money by Friday.
Yeah, and that in and of itself, I think it's probably a lengthy discussion. The reality is like, Most GPs, I think, are honest and trustworthy, and they're really just trying to do their best.
Right.
And some of them perhaps hoped that things would turn around and they wouldn't need to do a capital call. But I think
Mm.
there's a distinct difference between hoping and then sort of surprising your investors, or potentially even putting their capital at risk by not acting early enough. I've certainly seen situations like that. So I mean, yeah, that in of itself perhaps is
It's
a
like I say, we could talk for
conversation.
hours, but
Yeah,
but the dilution. Let's get back to that. So they don't know what the
yeah.
dilution is.
So
Typically,
going back to that, they have to ask. Like, I mean, like
oh,
if they have the documents, they have to look at them. To your point, many times it's not clear. Like many times the documents sort of give like the unilateral right to the GP to do whatever they want.
mhm,
But my point is the GP needs to define the terms. Like if you invest, what terms are you investing at? If you don't invest, what are you missing out on, so to speak, right? And that potentially has a very severe dilutionary impact. Um, it's a whole different discussion whether that's good or bad or ethical or whatever, to what extent you can do it. But the reality is, the LP needs to be presented with a set of options, in my opinion, as part of those options has to be what happens if I don't invest. Simple. I mean, it's a very simple question.
so if this answer is not immediately apparent to the LP, you're right. These are bright, typically highly educated, successful people. But
Yep.
they're not familiar with commercial real estate and certainly not familiar with what happens during a downturn. So they don't understand what's going on. And the GP has not articulated it clearly. To what extent do you dive? Do you say, "Oh, send me the offering docs? Let me have a look at them." Do you get involved at that level?
I typically don't look at legal docs. I'm not an attorney, so like I try to stay in my lane. Um, I think you can generally read the docs. I mean, anyone can read docs, right? Not just me, and that you can sort of pretty quickly realize whether it says like there's a specific provision that talks about capital calls and how they have to be treated, or it's just a very general language that says like, the GP might call capital in the future, and they will determine sort of like the economics of that outcome. And it's usually a binary outcome. Like it's one of the two. It's either super clear or it's not clear. To your point, many times it's not clear. In which case, like I think immediately it's just a question to the GP, like how are you thinking about um what happens if we don't fund this? And by the way, I think from the LP perspective and from the GP perspective, you have to avoid the answer like, oh, we're just going to face foreclosure and and like you're going to lose your investment. Like that's not what I asked you, right? Meaning emotionally speaking, the LP and to some extent, the GP might want to mention that or maybe just say that by itself, but that's not the question, right? The question is very precise and specific in that if I don't invest, how is my existing, capital going to be treated?
Okay,
Um,
so let me just peel back on that because that's a very interesting point. So what you've been talking about so far, although I've not read everything that you've written, I do follow you on LinkedIn, so I read quite a
yeah,
lot. So I'm assuming you've covered all this, but I'm going to ask it in a way that just peels this back. So don't take offense at the way I ask it. But
sure,
isn't the
sure.
point? So what you've been talking about is the mechanism, right? The mechanism is what happens if I invest? What are the economics? And if I don't invest, what are the economics? What happens to my original investment? Right. I mean, those are the
Mhm.
mechanics. But far beyond, more important than that, is the status of the deal. If a project, let's say we were working on a project, it was $100 million deal, 70 million of debt, 30 of equity, and the value of the project today was less than 70. So
Yep, happens all the
dilution,
time.
no dilution. What does it matter? The original investment is gone. That's it. It doesn't matter. If I don't invest, it doesn't matter. Diluted to what, even if there's no dilution, so what?
Mhm.
if the
Yeah.
value of that original investment is zero. So to
Yeah.
what extent do you get involved, and how do you figure out whether or not there is actually any value in the deal itself, in underwriting the real estate itself, which is upon which everything else counts?
Yeah, that's a good question. The first thing I would say is, to me, in my mind, those two are separate questions, right? In other words, the first question is simply like, I need to understand my decision. Like I'm making an investment decision, and just like you showed me what the pref was and the split is, and et cetera, like right now, my decision is invest or don't invest in the capital call, and I need to know the parameters that I'm dealing with, period. Like otherwise, I can't think about this in a mathematical way, right? Like the investment decision doesn't start because I can't think about it right now. Um, the second point that you mentioned is very related, which is also part of sort of like the list that I go through is like how's my existing position doing, right? In the example that I mean this is a tangential point, but sometimes, not always, usually not, but sometimes I've found that the GP does not understand how's the position doing. Um, however, I always say it's always a good idea if you get a capital call email to ask the GP, like, hey, I invested 500 grand. Could you please help me understand how much that 500 grand is worth today? By using numbers, like meaning don't just tell me like, oh, I think it's 500 grand, right? Like, but show me like the capital stack, i.e., how much equity was invested, how much debt was invested, right, et cetera, and how much is the project worth today, right? Maybe put some sensitivities around that because you don't really know what you can sell it for exactly, right? No problem. But at least I know, like in a framework, in your example, the debt was 70. So like is my position worthless because the project is worth 70 and we can barely pay off the debt if we sell it off? Or perhaps it's 80 and 90 or 90 where my equity is impaired, but not all the way. Um, the other point that I'll mention is that question is inherently um, it's flawed because it's point in time, like today. I mean, you're doing a capital call, so chances are there's some form of problem, right? But all problems are not created equal. In other words, there could be a scenario, and I've seen this. There could be a scenario where the building is worth 60 today, um, but like it's actually very realistic, like conservative, really realistic, that you can get it back to 100 in 2 years. Now the question at that point becomes, well, do I want to wait 2 years, 3 years to reinvest just to get my money back? Is that worth the risk? Et cetera, et cetera. That's a sort of a whole conversation. But I've also seen capital calls done on deals that are not underwater. Like, let's say you have a development deal that went over budget. The lender said, listen, we're done, we're tapped out. And you're forced to raise money from equity. Now you're like 95% done, pre-leased, like everything actually it looks really good. And in your $100 building in your example is worth 100, let's say, or 105. But if you just drop dead, so to speak, and like don't do anything, then you have to like force a sale basically at a distressed valuation. But like this building fully leased can be worth 150 or 175, like and you're just like at the final stages. But that type of capital call is not the same as a capital call that you've described, where like your equity is worthless or severely underwater, and you need to figure out like, is there a realistic path to getting it out and then getting a return on it or not?
Yeah, and that's the difference between looking at the new capital as a new, I'm sorry, as the capital being called as a new investment versus something that's protecting the old investment. If the old
That's right.
investment's been wiped out, you have to look at it as, well, what are the economics of this new money, and are there any alternatives? Like, what's the opportunity cost of me investing in this capital
Yep.
versus others, which was the very first thing that you mentioned. Quick
Yeah.
question, just so I know how to contextualize this. I've got another one. As far as your consulting clients are concerned, typically the sweet spot for you of for your clients is what somebody who's invested 500,000 and up, or 25,000 and up. Like, what do you what is that?
I don't I haven't really defined it. I mean, I'm
Mm,
just being honest. Like I've helped people that wanted to invest 5,000, and I have,
uh,
my own opinions on that as a concept. And I've helped people and I've helped people invest, or think about, investing a few million.
okay.
So it really ranges. Um, I think the investment process is slightly different, but it's also not that different. Across sort of investing ranges.
Um, Biggest complaints that so you speak to LP. I noticed that you have your I think LinkedIn post you put up today said something like all the calls that I'm having today. It's like my mind blowing. What do I doff my cap to you? Because I try and stay off the phone as much as possible. But I said a lot of
Biggest
them.
complaint,
Yeah, what would be like the top like get past the mechanics and the economics. What are they? What are the noise that? What's the noise you're hearing coming from LPs that you could perhaps generalize across the issues that they're having?
look, I think I would say two things. First, there's just like this very unfortunate sentiment of like people. I have, just to be clear, I have like a bias sample, right? Meaning people that call me need help. Typically, people that need help um, are in some sort of issue to the degree that they've realized they need help, right? But having said that, out of those conversations, I mean, you hear people losing 50% of their net worth to one syndicator, and you're like, why did you do that? Of course, I don't like say that, but like someone thought it was a good idea and they liked the person, and perhaps even they had a good experience, but they've like over allocated to one GP and potentially lost all their money, right? And so like hearing those responses, especially when people realize that, is just I mean, it sucks. I don't know what the, more proper um word for that would be. And the second thing is a related point, like LPs generally feel like they don't have a voice. Like they're like sitting there 100 grand, 500 grand. In many cases to the GP, they're kind of a rounding error, whereas to the LP, it's, I mean, in some cases, I don't 10%, 20% of their net worth. Um, which again, I have opinions on that too. But um, the challenge is that they're kind of in the dark. And many times they're seeing issues on their own deals while knowing that the GP is out raising for more deals.
Yeah.
Um,
So how do you react to that? I mean, I see that a lot, Alexei. I see sponsors, for example, like, I use Facebook for two things. He said, waving his phone for two things. One, jokes. But secondly, and by the way, I got lots of friends. Don't take anything personal, any of my friends listening, but I do not follow your feeds, any of them. I just use Facebook for silly jokes on various groups and ads. I like looking at real estate ads. And so because I click on so many, that's all that I'm fed by Facebook. And it blows me away to see sponsors who are losing deals,
yeah,
raising money for new
yeah.
deals. How do you react to that? And how does that fit into the equation when you are talking to sponsors? I mean, sorry, to LPs.
I mean, I think to discuss this, we might need another 30 minutes. If you want my short opinion, it's just extremely complicated. In other words, I'll just give you one example. So let's say I'm deploying out of $100 million fund. I'm a GP. Um, and I'm all over the news because I lost 10 million of it in foreclosure, right? Um, so on the face of it, like, and then I send out my new, deck, like, hey guys, invest in my next $100 million fund. So on the face of it, it's like, oh my gosh, like, what are you doing? Um, how can you do that? That's like not ethical. Is that even legal? But the reality is like investing is risky. Some investments don't work out. Um, and and I and in the example that I gave, there's a chance that on a fund basis, like for the entire fund, they've made up for that loss and maybe even doubled their money for that entire investor base in the fund. So I think it's very easy to judge these situations and just say like, someone who lost money should never be investing again. I think there are certainly there are those circumstances, um, but I think those circumstances tend to be like like there's a spectrum, if that makes sense, right? There's a spectrum across these situations, and some of them are, in my opinion, probably shouldn't go back to invest more. Um, but some of them, like something insane happened. And I'm not even talking about interest rates. Like, I don't know, like a fire broke out and X, Y, and Z happened. And as a result, they lost 50% of the money. So like, listen, welcome to investing. Like you can't predict everything,
Well,
right?
there are other aspects, aren't there? And you've talked about the fund, but inevitably, a sponsor who is struggling on some deals is going to get presumably less favorable. It's going to meet a less favorable lending environment, so it's going to be more costly and more
So
difficult.
yes and no, and I'll comment on that lending, but also equity raises
Mm.
because I have like 30 minutes of opinions on that. Like first on the lending environment, that could be true, it could not be true because I think
Mm.
um I I have some information on GPs coming from LPs that I don't know if their lenders know. Um, that's one. And even if that lender knows it, the question is, does the lender community know about it? Which is already a second degree of information. That's one. So it might not be the case. Now, of course, if you're in the news for foreclosures and problems, blah blah, then of course like lenders, probably quote you different numbers. Um, Now the second point is equity. Like, some people will always say, well, I don't care. Like, why can't I raise another deal? Like, this is just a marketplace. And if I find the equity, then clearly people believe in me. And I generally don't mind that statement, as long as you're being honest about your existing portfolio and your challenges. And 90% of the time, that's not true, right? People come to me and they're like, "Hey, I'm really interested in investing in this GP, and I have information that's not public about their, other aspects of their portfolio." Um, and so under a confi agreement, like I can share some of that information, and I never share it to say like, "Oh, look, they have challenges, don't invest." It's always, "Oh, look, they have challenges. Here they are." And you need that information in order to decide whether you should invest or not. Well, like both are fine, but you should make the investment decision with all the information that you could potentially have.
Yes.
And some of it is just being hidden. I think is the maybe
Being
the
what,
most
Alec?
important.
Being what?
Sorry.
You said that's being what? Hitted?
Some of the information I think is being hidden,
Oh,
like
hidden.
kind of like
Yes, yes, hidden. Right, right.
hidden under the rug, so to speak, in
Yeah.
terms of
Mm.
um raising new money, and there's like different ways to communicate what's happening with existing portfolios. It doesn't necessarily address the actual question, but many LPs don't know how to sort of read between the lines, and so they just take it at face value and invest.
Interesting. Alex, you're quite right. And I would love to talk to you for much longer. Let me ask you two final questions, however, just in the interest of time. We should certainly meet again. I do think it's a very interesting topic, and it is something that I've been working on very intensively. This whole thing behind me is about capital calls and rescue capital. I wrote a book. I actually, at the end of my little but $7 book, at the end of it, I did actually go in and pull down offering documents, and for my own sins, not being a lawyer anyway, pulled out the capital call or the dilution segments and
Mhm.
took, red line, not red line, black lined them. So made sure
Yeah.
you couldn't tell which deal it was from. They
Yeah.
are phenomenally complicated, and there's a whole
Yeah.
range of different structures. I think there's
Yep.
10 in this at the back of this little book, just to get an idea. It's really,
Yes.
really
Yes.
tough, not too difficult to find. Let me ask you two last questions. With the précis that I always have more than two because I come up with others. But let me try to just get two past you. I know that there's a third anyway. It's like a Monty Python skit, isn't it? The third reason we hate the Romans. Right. So first thing, so you have a biased set. I understand it. It's very interesting. Statistically, people that call you are of a certain demographic, a certain inclination. It's not a pure
Yeah. It's not. It's
audience,
not. I don't think it's the representative of
not
the
representative.
population.
All right.
Yeah.
But within the audience, your biased audience, let's call it that way, biased in the statistical sense. What are you reading are the hardest hit asset classes so far? And then I have a second question to follow up with that. What are you seeing are the hardest hit asset classes?
Um. I mean, I think the answer is pretty clear. I think like Sunbelt, specifically multifamily, and I've seen a lot in Florida as well. Um,
Have you
and
multifamily?
yeah, yeah.
That's interesting
And
because the flavor of the year 2023, of course, was office. And do you think there's less representation because fewer uh,
so that's what I
retail
was going to say.
investors invested in an office?
Precisely. In other words, your original question was, or the way I understood it was, out of the people that have called you, is there sort of like a majority makeup in the distressed world? And my answer was yes, like Sunbelt multifamily, some Florida multifamily. Now, where that goes haywire a little bit from a statistics perspective is we haven't talked about what percent of dollars in the syndication universe went into multifamily, for example, as opposed to went into office. And I think I haven't found numbers on this, and if you ever find them, please send them to me. I'd love to see it.
Mm.
But my hunch is that the vast majority, like certainly over 50% of syndication from retail investors specifically in the past few years, like let's call it 2019 through 2022, went into multifamily. Like I think it's like a massive amount
Mm.
as a percent of overall LP capitals that got pushed into the real estate space.
Yeah, not just of capital, Alexei, I think also, but in terms of numbers of investors as well,
Yes,
right? Just the actual
that
sheer
too.
number
Yes,
of
yes,
investors.
that's yeah, different, but also a very relevant statistic.
Uh,
Yeah.
so let's now I'm going to ask, of an economist, the kind of question that I know you love the most, to make a prediction for.
Yeah.
So here we are. I'm going to date stamp this January 24, late January. Actually, what is the date? It's getting later every day. But anyway, late January 24. Where do you think the market's heading? Where do you suspect? What do you suspect to see in LP activity over the next, let's call it 12 to 24 months,
Um.
or commercial
Yeah.
real estate
Yeah.
market?
Yeah. I'll make two comments. I mean, I think there's the good and the bad. So good is I think over the next 2 years, um, there will probably be pretty interesting deals as a result of the pain. Um,
Hmm.
the question within that is whether LPs will be ready to get involved in it. Right? Because I think LP investment sentiment is I don't know one I don't want to call it scarred, but like it's certainly more cautious. Maybe that's a better word. Um, and bad is on the other side of those trades is LPs that lost a decent amount of money, or all of their money, right? And so um, I think some people I've heard some economists even talk about how like rates are going to help real estate. I think generally speaking, that's true across like a very large, sort of like viewpoint. I mean, I have thoughts within that, but if you talk about retail money in syndications in multifamily, let's say as an example, I think lower rates will have like very little impact on what's to come over the next year or two, just in terms of like the debt issues, um,
Well, the point is
and
it's
so
not
on
going
and
to go
so
to
forth.
zero again, basically.
Yeah,
Okay.
like I think the chances or the narrative that like lower rates will save LP capital is overblown. Personally, I mean that's just my thoughts.
Aleksey Chernobelskiy. Did I get that right?
That
Chernobelskiy.
was really good. Good
Okay.
job.
I actually got it
Most
right.
people
Okay,
can't
good.
pronounce it. Yeah, that was really good.
Hey, have you ever watched this show? Where are you from, by the way? What's your nationality?
Originally from Russia. I came to the US when I was 11.
Have you ever watched this show, Barney Miller? It's like a 1970s
No.
cop show set in New York. One of the cops, his name is Wojciechowicz. He's a Polish
Mm.
guy, and it's spelt like Wosczzie, something like completely. And whenever anybody says, "How do you pronounce their name?" he always points to it. His name card on his desk. There, it's spelled. It's pronounced just like that.
Yeah,
It's like
yeah.
an ongoing gag that he has.
Yeah, yeah.
Anyway, Alexei, what a pleasure. Why don't you tell me or tell our viewers and listeners how they can get in touch, how they can sign up
Yeah.
to learn more from you.
Um, so I mean, I post several times a day on both Twitter and LinkedIn. My name is, pretty unique. So I think if you Google it, you'll be able to find me on Twitter and LinkedIn. And I also write pretty extensively twice a week on LP, which stands for like limited partner, lessons.substack.com. So LP lessons.substack.com.
Oh, that's a lot easier to remember, isn't it? And we don't have to actually spell it out. LP
Yeah.
lessons. I'm actually looking at
Dot
.substack.com.
com. Yeah.
Alexei, what a pleasure. Thanks so much for accommodating our schedule last week or the week before. I really appreciate it. It's an
No worries.
enormous
Yeah, yeah.
pleasure
Such a
meeting you.
pleasure to talk. Thank you.
All right, that was Aleksey Chernobelskiy. What an interesting fellow he is. Thank you so much for joining me, Alexei. It was a real pleasure to meet you. I do look forward to following up with our conversation, the conversation that we had after I so rudely disconnected you from the call right at the end there. The tech expert that I am managed to somehow hit the disconnect button instead of the stop record button. Anyway, it'd be good to talk to you again. And thank you to also, dear viewers, for joining us. I hope you found the conversation of interest. And like I said, if you would like to know more about Aleksey and how to reach him, how to sign up for his newsletter, just go to the podcast page at gowercrowd.com. And while you're there, sign up for our newsletter. It's totally free. Goes out once a week and covers all the latest news in commercial real estate, syndication, and investment on a weekly basis. You can always unsubscribe all there at gowercrowd.com. That's it for me this week. Thank you again for joining me. And until next time, this is Adam Gower signing off.